Treasury yields are down after US CPI data in April was softer than expected, but the Fed may still want to wait. The Aussie and Kiwi dollars are up sharply. There's good news for the RBA as Australian wage growth peaks, and Japan's economy may have contracted in the first quarter. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Head of FX Research, Mahjabeen Zaman, discusses ANZ's call this week that the US dollar won't weaken as much over the year as previously expected.
Lack of safe haven flows that has helped the dollar remain strong, and therefore we think over the next few months we expect the dollar to remain pretty firm until we get full clarity on the inflation trend for Q2 from the US.
But first, in 5 and 5 with ANZ, US Treasury yields are down 8 to 10 basis points this morning after softer CPI data for April supported hopes the US Federal Reserve can cut interest rates this year. Headline CPI rose 0.3% from March, which was a touch below expectations, with the annual rate down slightly to 3.4%. The closely watched core CPI rose 0.3% in the month and was up 3.6% from a year ago. That was in line with consensus. Supercore inflation at 0.42, it was the lowest increase this year. The data was also supported by flat US retail sales in April. The S&P 500 up at a new record high, 1%, at 4 a.m. Sydney-Melbourne time, while the US dollar index was down 0.5%. The Aussie dollar jumped 1% to 66.88 US cents, and the Kiwi was up 1.3% at 61.17 US cents. ANZ Head of G3 Economics, Brian Martin, says the monthly CPI data adds to confidence that inflation resumed its fall back towards the US Federal Reserve's 2% target in the June quarter, after stalling in Q1. But he says the Fed will still want to wait to gain greater confidence before cutting rates.
It will draw some encouragement that maybe they are beginning to get the green shoots of confidence that they require. And I think importantly, the fact that April retail sales were unchanged and that the control group of retail sales, which is what's the element that is used to calculate GDP, that actually fell 0.3% in the month. And control group sales have been negative in 3 out of the first 4 months of this year. I think the Fed will say, look, inflation's come off a bit in April. Demand does seem to be weakening. We think, therefore, that if we hold the course, we will get inflation down and we will get that confidence we require to be able to start cutting interest rates to deliver the much sought-after soft landing that they would like to see for the economy.
Number 2, Australia's wage price index rose 4.1% annually, slightly below market and the RBA's expectations. ANZ senior economist Catherine Birch says it appears wage growth peaked back in December, which will be welcomed by the Reserve Bank of Australia.
We don't think it'll be enough in and of itself to shift the RBA's thinking, and we still see the cash rate being on hold at 4.35% until November, with the risks probably still tilted a bit towards later rather than earlier start to cuts. We saw at the last meeting the RBA board appears a little more concerned about the impacts of wage growth on inflation, saying that wage growth is still above the level that can be sustained given trend productivity growth.
Number 3, Catherine expects Australian jobs data for April to show employment down 10,000 and its unemployment rate rising to 4%. Some of that softness could be driven by the fact Easter and the school holidays fell during the survey period, though.
We think it might be a hard one to interpret given the potential impacts of seasonality not captured by the seasonal adjustment process. So our expectation is that we could see a soft April print, but then a stronger May outcome. And you'd probably need to see a few prints in a row of an easing trend for the RBA to really read that we're seeing that ongoing easing in the labour market.
Number 4, Japan's economy is expected to contract slightly in the March quarter, driving a consensus forecast for a 1.2% drop in GDP over the year. ANZ FX analyst Felix Ryan says part of the weakness could be driven by a one-off disruption to car production.
That could see a fall in exports and a reduction in domestic car consumption. More broadly, it's what we may see further evidence of softer business investment and weaker consumption. In terms of any implications for monetary policy from the data today, certainly a weak set of numbers for GDP wouldn't be very helpful for an aggressive or for taking an aggressive monetary stance by the BOJ.
Number 5, the Philippines Central Bank decides on monetary policy later today. ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, expects rates to be left on hold at 6.5%.
We don't think that a hike is on the cards, but nonetheless, the BSP will have to sound hawkish because even though the last two inflation readings have been below market expectations and within the target range, there are quite a few risks out there, particularly with regards to food prices, which can impact inflation in the Philippines to a larger extent than in several other economies.
Sanjay Mathur there. Now, in our bonus deep dive interview, Mahjabeen Zaman highlights the key reasons behind ANZ changing its call this week on how much the US dollar is set to weaken over the year and what that means for the Aussie and Kiwi dollars.
I think when we started the year, clearly we started the year with, the market expectations of 5 to 6 rate cuts from the Fed price 10. Today we are looking at a much lesser amount. So as a result, I think what we have really done is we have adjusted the pace of our US dollar easing into the end of the year. Previously, we had an expectation that the dollar index, the DXY, will end the year at 98. We have adjusted this a little bit higher to 102. So we're at 105 now. So we do expect the USD to continue to weaken, but at a little bit of a slower pace. Now, clearly, a couple of drivers for that. And we think that obviously US data so far, the US exceptionalism theme for at least the first quarter of this year has followed on. We are starting to see a little bit of cracks, especially in the jobs numbers. Safe haven flows from Q4 last year have also been a little bit more supportive for the dollar, given that in safe haven currencies, there's really no other alternative. We look at Swiss franc, the SNB has started cutting rates, so that has weakened. And of course, dollar yen, when we look at yen, that has weakened to record lows as well. So lack of safe haven flows that has helped the dollar remain strong. And therefore, we think over the next few months, we expect the dollar to remain pretty firm until we get full clarity on the inflation trend for Q2 from the US.
And just looking at the various currency pairs, the Australian dollar and the New Zealand dollar, the reserve banks there seem pretty comfortable holding for quite some time at the moment. How do the various pairs move within that overall forecast that you have there for the US dollar index?
Look, I think first and foremost for the Aussie, we are looking at the Aussie dollar to end the year at 0.69. So we are broadly constructive, the Aussie dollar. And really, to your point, just a couple of drivers there. I mean, as we have seen the Q1 CPI and the more recent RBA meeting, it does look like the RBA at the very least is likely to be on hold for longer vis-a-vis the other central banks. And so that will be carry supportive. It's the same story for RBNZ. We don't think RBNZ is going to ease, at least not until next year. And as a result, I guess the carry still remains on the menu for within the FX space. Furthermore, I guess when we look at Aussie specifically, obviously the higher commodity prices, when we look at iron ore and, possibly some stabilization in China coming out, particularly on the export sector side of things, may also be supportive for the Aussie.
Mahjabeen Zaman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, May the 16th. Catch you tomorrow with the detail from Japan's GDP numbers and further reaction to those US CPI figures. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.